It's a breakout. Yeah, it's clearly a breakout. I would think silver's going to go at least to 50 and test that. I don't think longer term 50 is going to hold. I mean, we're going to go above 50, and then who knows what kind of numbers. And gold, I mean, there is no technical area or number because we're at all-time highs at this point, and just have to see where the next battle begins. But this is a breakout, and I view this as a worldwide vote of no confidence in paper. An ounce of gold is an ounce of gold, and an ounce of silver is an ounce of silver. Whether it be today, 100 years from now, or 100 years ago, it's still the same 1 ounce. What's different is the currency and how much that currency will purchase. And you're using the number 3,500 for gold. In 1971, gold was pegged at $35. So what does that tell you? It tells you the dollar since 1971 has lost 99% of its value, of its purchasing power. Front and center for me right now are the Japanese 10 and 30 year interest rates, and along with that, the yen itself. Literally trillions of dollars were generated by borrowing in yen. It's the carry trade. It's really what blew the Western bubble through the roof. It created capital to afford, buying of all kinds of assets. They were borrowing for years at call it 0.25%, and now on the 10-year we're up to 1.6, and on the 30-year we're up to 3.2. You've got it blows it up, because if you're borrowing at 0.25%, that's what your model shows, and then all of a sudden you wake up and you're now paying 1.2%, and if you've got a stronger yen at the same time, it blows that trade up, which causes margin calls. And if you close the borrow side, you've also got to close the long side. So it could be really disruptive. And oddly enough, well, maybe not oddly enough, but if you overlay a chart of gold with the Japanese bond market, gold and the Japanese yields, or the inverted prices, if you will, they seem to be going in lockstep.
The rapid rise in Japanese bond yields has caught investors off guard. Those who once borrowed at near zero rates now face higher costs, compounded by a strengthening yen. This shift has led to margin calls, forcing investors to liquidate positions, creating a ripple effect across global markets. The unwinding of these trades is not just a financial event, but a systemic risk.
It is destruction of the currency, but the result is, as those yields rise, if the yen strengthens with it, it blows up the borrowing side to the carry trade. The carry trade was basically free money for many years. Now it's in reverse, and it's going to force some long holders. It's going to force them to sell. It's a giant margin call in the making. It's happening as we speak. If you own whatever bonds, whatever sovereign bonds, whether they be U.S. or Japanese or whatever, you're putting your faith in the creator or the issuer of those bonds. And what this illustrates, the bonds are being sold, and a lot of that money is going into gold. The bonds are being sold because the confidence is breaking. The confidence is nowhere near where it was just a couple of years ago. It's a breakout. Yeah, it's clearly a breakout. I would think silver's going to go at least to 50 and test that. I don't think longer term 50 is going to hold. I mean, we're going to go above 50, and then who knows what kind of numbers. And gold, I mean, there is no technical area or number because we're at all-time highs at this point, and just have to see where the next battle begins. But this is a breakout, and I view this as a worldwide vote of no confidence in paper.
As confidence in fiat currencies wanes, investors are turning to tangible assets. Gold and silver have seen increased demand, with prices reaching new highs. This trend reflects a broader shift away from paper assets, signaling a vote of no confidence in traditional financial systems. The surge in precious metals prices underscores the growing desire for security amid economic uncertainty.
An ounce of gold is an ounce of gold, and an ounce of silver is an ounce of silver. Whether it be today, 100 years from now, or 100 years ago, it's still the same 1 ounce. What's different is the currency and how much that currency will purchase. And you're using the number 3,500 for gold. In 1971, gold was pegged at $35. So what does that tell you? It tells you the dollar since 1991 or 1971 has lost 99% of its value, of its purchasing power. This has been going on. It's been going on and on and on. We've had a bull market, if you will, in gold. But the reality is it's been a bear market. It's been a diluting market in the dollar and other currencies ever since we went off the gold standard. I would think if the dollar should be bouncing pretty hard right now, it's not. And what won't go up must go down. So I think there's another leg down. But again, I don't think the DXY is really a good index to look at, because you're looking at dollars versus other paper currencies, the euro, the yen. The true measure is versus gold and silver. And that verdict is already in.
The U.S. dollar, once the world's dominant reserve currency, is showing signs of strain. Despite efforts to bolster its value, the dollar's purchasing power has diminished significantly since the U.S. left the gold standard in 1971. This decline is evident when comparing gold prices over the decades, highlighting the erosion of dollar value and the shifting dynamics in global finance.
Right, because gold was $20.67, and then they revalued. They took everybody's gold and they revalued it to $35. And that, there's a lesson to be had there. When they revalued gold from $20.67 to $35, that started to break the back of deflation. It was an inflationary event. And there's all kinds of talk wherever you look now about a gold revaluation worldwide. Well, what is that telling you? It tells you that they're desperately trying to reflate the system. And they have to reflate the system because of the amount of debt that's outstanding. And it all goes back to the late, great Richard Russell, inflate or die. In this system, we cannot have deflation. You cannot have deflation of assets because everything is held up on margin. And when assets deflate, you get a margin call, then the entire system comes down, and basically currencies become literally worthless because they're based on the full faith and credit of the issuer. And all of these issuers, from the United States to all the Eurozone, they're all bankrupt. They're all upside down and insolvent.
The current financial system operates on a fractional reserve basis, where only a fraction of deposits are backed by actual reserves. This structure is increasingly under scrutiny as more investors demand physical delivery of precious metals. The rising number of contracts standing for delivery, especially in silver, exposes the vulnerabilities of this system and the potential for widespread failures.
Yeah, short squeezes will end in a failure to deliver. Because what happens is when you tell someone they can't have something, they want it even more. That's human nature. And we're at the point now the sharks are beginning to smell blood in the water, that there's not enough platinum, there's not enough silver, there's not enough gold to meet the deliveries. And if any of these contracts fail to deliver, they'll all fail to deliver within 72 hours. I guess the best or a funny way to describe it is, I don't know how long ago it was, 30 years ago, 40 years ago, whatever, when Beanie Babies came out. And, if you promised your kid a Beanie Baby for Christmas, but you couldn't source it, that's that's the way everything's going to go, is that people, because they're told they can't have something, they want it even more.
Right. And that would act as fire to the flames of this failure to deliver.
Right. It'll create more demand. And along with creating demand, not just paper demand, you're going to have more and more people buy contracts and then immediately stand for delivery. As a matter of fact, for the last 2 or 3 years now, it used to be, and I'll use silver as an example, it used to be that there were X amount of contracts standing for delivery on first notice day. And then by the time delivery day came, final notice day, the amount of contracts outstanding would have dwindled by 50% or more. Over the last 2 or 3 years, what has happened is you get X amount of contracts on first notice day, and then by the time of the last day, final notice comes, there's more contracts outstanding, and in some cases, there's more than double or triple the amount of contracts that were standing the first day. So you have buyers that have been coming in and immediately standing for delivery, and that's the Achilles heel to the fractional reserve system.
As traditional financial systems face mounting challenges, the future remains uncertain. The rise in bond yields, coupled with shifts in investor behavior, indicates a potential realignment of global financial structures. Investors and policymakers must adapt to these changes, considering alternative assets and strategies to navigate the evolving economic landscape. The coming months will be crucial in determining the trajectory of global finance.
There's no question. Even the powers that be will admit, yes, it's a fractional reserve system. We really only have 5% or 10% of the metal or whatever it is available for delivery because not everybody stands for delivery. Well, we're at the point now where there's more and more understanding that because it's fractional reserve in nature, it will ultimately fail to deliver. And again, the psychology of human beings, when they're told they can't have something or they might not be able to have something, they want it even more. And it's going to cause a stampede of contracts standing for delivery, and that'll be your failure to deliver, which blows up the entire system, by the way. Because if you've got all these contracts that are actually worth zero because they cannot perform, it breaks confidence. And let me back up a little bit. The reason gold, and of course silver too, silver has been suppressed because they didn't want the fuse on gold lit. And they don't want the fuse on gold lit because if you've got $25,000, $50,000, $100,000+ per ounce for gold, that shows no confidence or a lack of confidence in the paper. On the other side of that, their confidence is absolutely needed in order for the U.S. Treasury to borrow the ridiculous sums that we've been borrowing. We have to borrow $2 trillion a year just to balance the books, just to keep the system afloat. So they suppress the price of gold and they'd whack it. You remember, go back, 10 years ago, 15, even 20, 25 years ago, gold would start to pop its head up and they'd whack it, 1%, 2%, 3%, which back then when gold was $300, $400, a $10 move in gold was huge. And it was demoralizing to see all of a sudden gold was going higher and boom, they smashed it. Well, the reason they smashed it was because they want to be able to point at the price of gold and say, see, gold bad, dollar good. And that allowed the confidence for the rest of the world to buy treasuries and fund the U.S. deficit. At this point, that's starting to unravel because you're seeing some very big sovereigns liquidating U.S. treasuries and turning around and replacing that with either gold or silver.